Good afternoon. We're live. Hi, Nigel.
Hi, Nicky. How are we?
Yeah, I'm good. And
Good.
obviously, excuse me today. I am still in holiday mode, but I have paused my holiday so that I can speak to Nigel today. So welcome, and just anyone that's watching live, because I know that we have some people watch later on. But if you're watching live, please do put in your comments, say hello. Now, I'd just like to know, it'd be useful. Nigel's looking a bit blurry to me. Now, it could be that I've forgotten to put my contacts lenses in this morning, but can you just let me know if it's looking normal on your screen? Because it's weird, because I've got one screen that looks great.
Sorry, I shouldn't do that.
A bit softened. Anyway, so just no problem. So great. So I'm delighted. I've got Nigel with me. He's the first time to the Business BoardCast, but he's not a stranger because he's a regular watcher. Hi, Tori. Tori's there. Hello, Tori. Brilliant. So we are live and it's working. Tori's back in the office there. Hi, Tori. Keeping it going whilst I'm on holiday. So yes, Nigel, but also not only is Nigel a regular listener, he's the person that came up with the name. He is responsible for this being called the Business BoardCast. So thank you, Nigel.
That's a pleasure. Well, it's ulterior motive because I'm from the business board. So there we go.
And in fact, the person that brought us together originally, Nigel,
is he listening?
The young Peter Felix. He is saying, yes, you are looking blurred, but it must be the wine.
I wish it was, Peter. I wish it was. And it will be later. But thank you. Nice to see you. And thanks for joining us.
Okay, so Nigel, I've asked you to come and join us today, not only because you're a regular, but you've got lots of experience of running your own businesses, but also advising businesses. And can you just give us a little bit of background? Sorry, I haven't been on the wine yet. That's later. A bit of your background. And just so that anyone that doesn't already know you, though I know that most people already do, but just anyone that doesn't know you, just give a flavour.
Of course. Okay, very briefly about me. I started life selling computer systems for the sort of first 5 years of my working life, and then basically set up my first business then, which was marketing to computer suppliers, obviously from my sort of history within that, and have basically ran my own businesses ever since for the last, I'm afraid to say, 30 years now. Probably at their peaks being about 10 million pounds turnover, or for our US friends, that would be about 14 million US dollars. So that sort of level of business at its peak, and then smaller businesses, but generally they've sort of all been marketing led in some shape or form. So
excellent.
You were flicking me off the screen. Am I still?
Yeah, I know. I was just trying to see if I could try and make you not blurry, but it didn't quite work. So
sorry.
No. It's not your fault. Do you know what? I wouldn't be surprised. I mean, people on here, I'm sure, are much more au fait with technology things than I. But there are a lot of different systems going down today. I know half the banks seem to be down today, and Sky's down, so I wouldn't be surprised if that's interfering, but it's not gonna detract for what you're gonna say, Nigel.
Well, I could certainly take the video off so everybody could hear me. That might be a better way to do it.
Yeah. So today we're going to be talking about improving the value of your company, but in particular regarding improving your asset ratio. So Nigel, just remind us, because obviously everybody listening to this knows what an asset ratio, but just remind us what exactly is an asset ratio.
I mean, in a nutshell, it's the liquidity ratio of your company. So your sort of your assets, your fixed assets, your current assets against really the liabilities. So it's the profile from the balance sheet that we'll be looking at. Now, it sounds a really dry subject, and we'll hopefully not make it that. We'll actually tackle it from a more commercial viewpoint. And I'll give some examples of how clients have done it, how I've done it in the past, have improved that ratio. But basically, it's the liquidity of your business or the value of your business as well.
Yeah, absolutely. So, and that's a really key ratio. Quite a few of my clients, as I said to you before we were on the air, do actually use asset ratio as one of their KPIs, because it does give them confidence for the longevity of their business. So, it's one way that I describe it is, if you had to stop with your balance sheet tomorrow, how much would you be able to cover? What assets would you be able to liquidate to cover by the liabilities that you've got to pay off? So, you want to make sure that you can cover everything. So, anyone that's got a ratio of more than one, but if it's a lot more than one, the better. The higher, the better of that ratio. Brilliant.
Absolutely.
So why should we? I mean, you touched on a little bit, but why should those business owners out there and managers of businesses out there concentrate on the asset ratio? How can it improve their business by doing that?
I mean, one, as you rightly said there, Nicky, for the longevity of the business and the security of the business to continually improve the balance sheet, the ratio, the assets against liabilities. It's just a brilliant business practice to continually analyse it. And funnily enough, you mentioned a client uses a KPI only this morning, because it's coming to a year end on one of our businesses. We were just drilling down on the balance sheet, tidying it all up, and then making it as sort of presentable as possible, because the answer to your question why is, when you're presenting that to banks, to finance houses, and really to the outside world, if you're considering any sort of exit strategy for your business, the year-end accounts are a real marker in time that people will always review. So, for example, if you're selling your business, people would look back on the previous 3 years generally as an average, and unless there's some exceptional circumstances, that's how far they'd look back. So it's important to continually make that and present it in the best light possible.
Absolutely. And there's some quick wins that you can often do as well on improving your ratios. So especially if you're looking at particular year end. So things like just do a little quick tip. If you normally issue your dividends at the end of your financial year, or if you haven't got an overdrawn loan account, and if you're absolutely fine to wait a little bit for your dividends, issue them on day one of the following year, because that means your cash is still in the business, and that's going to be improving your ratio, rather than stripping it out each year. So there's lots of little quick things that can be done if your balance sheet isn't in too much stress. So apart from my little quick one there, what other ways can you improve the asset ratio of your business?
I mean, there's several. But what and I probably won't do it, and I'll leave the accounting terms to yourself, Nicky, but from a more business owner perspective, I think you're always looking to drill down the costs anyway, but parking up the P&L, profitability and the overhead sort of lines there. If we're just looking at the assets, I think the very first place to start, and in fairness, is the cost of your finance. And it's good to sort of constantly review and try and reduce what the cost of capital is. So how much interest are you paying? How long are the loans? And what are all the arrangement fees involved and everything? And it sounds something that people think, well, I'm always looking at that. But actually, you look at it when you take out a loan, and then generally you park a loan up, and get on with your day job again. And so at the moment, for example, we haven't had a better time than, obviously everybody's hopefully sort of made the most of the CBILS, the bounce backs, but there's the recovery loan scheme until the end of December, and that can be used to sort of great advantage to try and reduce some of the, you know, pre-pandemic rates people were sort of paying. So I'll probably start off with saying, just analyse, go through with your broker, go through with your accountant about reducing the cost of capital. And in fairness, as Pete Ames said in the comments yesterday, the best time to review is when you actually don't need the cash and you can review it, and then you're in a better position. And also, if you're tightening up your balance sheet a little bit, then that's a good time to sort of put it out there to say, you know, this is what the plan is. This is our affordability. This is where we are now, you know, in 2021. This is what 2019 looked like. And all those bits, if the jigsaw fits together, you'll be able to improve on your rates. So
absolutely, yeah, that was a great tip from Pete and yourself. Yeah, so what a key thing which I always bang on about is plan, because if you're planning, then you've got a chance to actually think, well, what resources are you going to, what funding are you going to need, you know, next year or the year after? Is it, you know, are you going to need to move offices, if you're going to have additional staff, you know, is there big infrastructure that you need to buy? And planning and getting the right timing for those funding options can often save you tens of thousands of pounds if you get the right one. So yeah, you're never going to get the best rate doing it the last minute, are you?
No, and certainly at the moment, because obviously with the recovery loan scheme, they're backed 80% by the government, you know, and up to 250,000, there's no need for a PG. And I hate that everybody uses the word unprecedented, but it is always, people would ask for a PG. It's always happened and it's not there. So it's a great time to try and just ease some of the commitments that you may have. Yeah, so it's worthwhile looking at that, and that runs till the 31st of December. And I don't think there'll be anything sort of after that. But
yeah, absolutely.
So we'll see.
Not with such favourable terms. So that, you know, so we've looked at cost of capital, you know, getting the right cost of capital and the right funding there. But what other types of things? By the way, just to remember, especially as we've got some more questions coming in, do put into the comments any questions or any comments, anything you want to share. If it could be about the topic today, it would be useful. But anything you'd like to share, I mean, it's Friday after all. So Nigel and I are here to help. You know, we've got, what's it now, 60 years experience between us, so hopefully something to share. Something to share, useful, because it's not just about funding as well. Before we go on to the other types of things that can help asset ratios, which outside of the sphere is funding, there is a funding question that's come in from the lovely Nick Phillips. So his question is, he's got a very smart photo there. Where's the best place to start when approaching lenders for funding options? Where's the place? Not when. Where's the best place? Where is the best place, Nigel?
Well, Nick, it's as if that had been staged. Thank you for that question. Very good.
You know this person, Nigel?
I've never heard of him before. It's a shame Lynn from Barclays isn't here, because I always say to everybody,
she's having a lovely time on the beach. She's not having a staycation. She's having a lovely time.
Fair play. Look
at her Instagram. She's having a lovely time. Anyway, sorry, Nigel.
So yes. No. So the very best place to start is the high street. Go to the high street first. That's where you will always get the best rates. And if you are with whichever bank you're with, obviously go to those, your existing bank, and then other high street lenders. I think from there, we'd look at some of the challenger banks, and they all offer a different level. I'd certainly say with the recovery loan scheme, a different level of appetite, should we say, for what they're willing to offer. So some will be at the 25,000 to 250 arena of lends, then maybe 250 to $1 million are others, and they're saying that's the sort of cap there. And obviously the 250 is where the PG kicks in or not. So again, within the challenger banks is the first ones to start. So for the likes of people like Metro or Starling Bank, some people like that, and then moving on to some of the bigger banks for the much larger lens. Maybe some of the private banks are the sort of route to go. So they would be the first places to start, and it also depends on the type of finance that you're looking for. So, and what the lend is for, what the security is, and also the profile of the business. So some are saying acquisition finance, and we're getting quite regular calls saying, have you got anybody? Is there anybody looking for it? Some of our banking colleagues, they're really eager to lend money, while in truth 80% of it is covered by the government. So they're the sort of areas. So it depends on the lend. It also depends on your own profile as well. But equally, we mentioned, Peter, from Muse earlier, a sort of great source for sort of spot finance and invoice finance, as well as some of the others. So
that's a good segue. You've just mentioned invoice finance, because the Peter Felix, who was our last lunch before lockdown, his question is, where do you both? I think that's one, but where do you find invoice finance fitting into the much heralded recovery post-COVID?
Well, Peter's probably the better one to answer that question.
Well, I'd say it does fit in, but you go and speak to Peter.
Yeah, but it's absolutely part of the mix, and a lot of invoice finance facilities are backed by the recovery loan, if that then fits into the category. But there's, and in fairness, speaking to Peter, there's the time when it comes when a lot of the support's withdrawn and businesses start to grow again, because unfortunately we've seen some businesses decimate. We've seen some brilliant success stories, but there's a lot we've seen decimated, and their turnover is down considerably, less than half in some cases. And those companies have got to grow again, and they've got to finance that growth. So I think at that point, the invoice finance will really sort of kick in to help that growth. But again,
if you haven't already been using it,
of course,
definitely. And it does certainly invoice financing is more straightforward to use in certain sectors than others as well, because you do have to make sure you verify your invoices in certain ways and different things. So if you do want to talk about invoice financing, have a chat with Peter. You can find him on LinkedIn.
I think also in the whole scheme of what we're talking about, and I know Pete would agree, but in the sort of longevity of businesses and what they need, some of the finance should be hurdles that you then use, or springboards that you use to get over a certain hurdle, like what we're going to be going through over the next 12-18 months, but then look to implement a debt reduction strategy. Don't try, unless your business model needs it because of the cost and everything.
Of its fast growth.
Yes, yeah.
So that nicely goes on to non-debt strategies. So let's talk about extra capital. So actual investment from wherever. Talk to me about what's the best thing to start. I mean, then that's what you do a lot in your day job, Nigel, is get investment for various businesses, capital investment. So where do you start in that scenario?
That's not on my list though. So
oh well, I'm just adding it in.
Yeah, no, that's fine. So well, really, in answer to Nick's question earlier, obviously, you know, in fairness, it would be coming to speak to us about what's the best route, how to then do it. This is my this is my requirement. This is what I need. But probably more specifically, if I may, I'll just move on to a couple of examples, because it might not be more finance that's the answer. And there's somebody who inquired about invoice finance to us, a big packaging company, £5 million turnover, great big warehouse full of all packaging items. Anyway, they sent all their financials across, and the stock holding was horrendous for the size of company that it was, and it was just massive. And once they sent it through, I didn't sort of say, which invoice finance would you like? I said, just tell me a little bit about the stock and why is it so high? And he sort of says, oh, just come and have a chat to us, would you? So I went down there, and they kindly walked me around everywhere and showed me the bits. And then we sat in the meeting room and went through in quite detail the stock report. And I was obviously offering invoice finance. And we went through it. And by the time we sort of finished, it was about 75% of, I wouldn't say redundant stock, but certainly stock that was very dated, 2 or 3 years old. And we then talked it through, and he goes, well, to be honest, actually, I could bin it. I just haven't got round to it. We worked it out, and the cost of him holding that, working out the square footage and the cost per square foot and everything, it was about £250,000. So
wow.
I know. And this was just pre-pandemic, and he had people that wanted storage from him and things like that. So I suppose sometimes the answer always isn't more finance. And there's a couple of other examples. I don't know if we've got time for them, but
yeah, no, good. Let's do another couple before we have any final questions.
Okay, I'll quickly rattle another off. But basically, somebody with a number of retail outlets, he came to us for a cash flow loan. And this is the other big one to avoid. And it's horrendous when you see it. And if you're not exposed to it, you probably don't know about it. But some of the interest rates out there can be 15% plus in certain arenas. And obviously, when we're talking about cost of capital, it's to avoid them like the plague. And when we drill down on this particular client, when he was sort of saying, this is what I'd like, this is what I need about 200,000. It was really to service all the loans. And so the same problem is going to come back further down the line. And we talked about his business, and it actually transpired. He'd had an offer for one of the shops, and it was a good offer. It was a loss-making shop. And I sort of said, well, so why don't you sell it? He says, oh, I don't want to do the deal. I don't want to deal with the bloke and everything. So we helped do the deal. We spoke to the solicitors, did heads of terms and everything for them. And unfortunately, never sold him any finance, but equally it's doing the right.
That was the right thing.
Having the right solution. And the poor chap, if he'd have taken out more finance at those sort of rates, you know, it's on the slippery slope, isn't it? Yeah. So it's those sort of situations that I think that finance isn't always the answer. And if I've got time for one very brief one,
sure.
The other element is, if you're looking at your business and it's sort of multifaceted, generally there'll be some departments that are probably not as successful as the other departments. And that sort of profile of companies, and the one I'm going to use, we've got somebody who specializes in printers, sale of printing companies. And he went into this company and they did everything from cutting the paper to finishing it to the direct mail to everything across the board. And it was actually their direct mail department that was running at about 15%, 20% of capacity, there was 5 or 6 people in the department. It took about 2,000 square foot. They had equipment in there that was just standing idle a lot of the time, that they got loans on and everything. And we just sort of said, why are you running that department? Why don't you outsource that and pull that together? But I think when you're head into the business, you don't always see these things, and it's very hard. And we actually sold on, well, not in that, in another instance, we sold on the company, the element of the business that we'd highlighted that was loss making for them. So it doesn't have to be a sale of a whole business. It can be just a department that you then sell on. And for somebody who specializes in that area, you know, that can be welcome sales, welcome turnover, and also makes them profitable and makes the original company more profitable. So there's different ways to tackle it, and it's a matter of just drilling down and analysing, you know, what you have got.
Absolutely. Another classic one in like the services space, you know, if you look at your, you know, your bottom level clients that, you know, that you don't make so much money on, well, you know, is that the time that you actually go, well, perhaps I should use that resource to service other more profitable clients? So it's not necessarily always about growth. It's about having the right client mix or the right product mix, isn't it? Absolutely.
Yeah, absolutely.
Absolutely. So let's. I think that this is a good time now. We've just got a few minutes left, so it's a good time to just summarise the top tips, because you know, this is a topic that we could talk all afternoon on, because there's so many things that you can do to improve your asset ratios and improve your balance sheet and essentially then the value of your business. So what are the sort of few the main takeaways that you'd like people to take away this afternoon and perhaps have a little think over of their own business, Nigel?
I think obviously the first one is analyse and try and reduce the cost of capital. Have a try and incorporate a debt reduction strategy, which, as you said earlier, Nicky, could be over a number of years of just targets to sort of try and meet there. I think the second one would be to dispose of underutilized assets. There might be old machinery, there might be older kit that just isn't being used, and when everybody's getting on with their day job, they may not see it. But also departments and areas, and if you have got various elements to your production process, it's sort of looking at that. And I think finally, I'm actually probably taking one of David Samuel's from last week, in the sense that just always make time to review. And that's one of the qualities he was mentioning in leadership. Just take yourself out of the business, look at it all, and drill down on various aspects, and have that sort of strategy in place.
Excellent. So really good. So everyone have a chance, whether it's this afternoon or perhaps it's going to be a Monday morning task, you know, to have a little look and go through those things. Nigel's available on LinkedIn to connect to if you want to have an informal chat with him. Yeah. Otherwise, you know, if you aren't sure, you know, obviously happy to contact me as well, you know, but utilize people you already in your network. You know, you ask your accountant to give you some advice there, you know, and make sure these sort of things are included in your planning for next year. So, Nigel, thank you very much.
Absolute pleasure.
Always lovely to see you. What have you got? Good plans for the weekend?
Actually, my daughter's just back from a short holiday, and she's promised me lunch on Sunday. So that's just her and I.
Nice.
And so that'd be lovely. So that's the highlight.
Excellent. Sounds good.
Yeah.
Oh, I'm hoping for some sun. I've been my week off, so I've been going to various garden centres, and I think I still need to fit in another garden centre trip yet. But it'd be nice to actually have some sun in the garden. But thank you so much. Just so everyone's aware, next week I believe it's going to be another visitor from Macbeth's. I'm not sure which one it's going to be yet, but which of the lovely Macbeth chaps it's going to be. But we're going to be talking about cyber insurance. Really important thing. You know, so many businesses are getting hacked, or their data being compromised, etc. And so it's really important to understand what exactly is happening and how cyber insurance could help protect you, etc. So do join me next week to talk about all things cyber. And thank you so much, Nigel. Have a lovely lunch.
Pleasure. Thank you. Cheers. All the best, everybody. Bye.
Cheerio.
Bye-bye.